Okay, so first of all, thanks to Jim and Avner for hosting such a superb conference, to Mike for chairing, and also to the program committee for selecting our paper. So it's joint work with Jose, who's sitting over there. And let me start by just describing the paper sort of very simply. So it's a somewhat descriptive paper. And what we're going to do is we're going to observe a credit supply shock in a single bank, and we're basically going to trace that shock to multiple borrowers at the bank. And the purpose of this is basically to understand at what margins the bank cuts lending to borrowers. And in particular, we're going to look at heterogeneity in borrower type. And one thing we're going to do specifically is look at collateral, because we have asset-backed lending. Excuse me. In doing so, we're hoping to shed light on two things. First of all, basically financing constraints per se, and also how might firms be able to insulate themselves from credit shocks. Before I go into the paper, I'm also going to add sort of, one other comment. This is fairly early work, and I'm certainly not apologizing for that. But in the spirit of Wayne's comment yesterday, if you do have comments, they're going to be incredibly valuable. We don't have referees already hunting us down. It's certainly not near submission. So we're going to listen to your comments, and we have time to incorporate them. So they'll be very valuable. So why do we care about this, first of all? I think that there's a lot of evidence which says that bank liquidity shocks impact borrower firms. And in particular, they impact borrower firms even when the investment opportunities of those same firms don't change. But we don't really know specifically how they impact those firms. So for example, do banks just cut uniformly across all firms? Do they cut by borrower type? Do they cut at certain types of margins? And that's really where we're going, and then by doing that, we're going to shed some lights on borrowing constraints. So what do we know about credit supply shocks or liquidity shocks? Well, we certainly know a lot about the bank lending channel. This is the notion that bank experiences a liquidity shock, the same bank is unable to cushion its borrowers from the shock, and therefore these borrowers become financially constrained, despite the fact that their investment opportunities or their demand for credit is unchanged. But most of the evidence here is on aggregate effects. We see an aggregate credit supply shock, and we see that on aggregate, firms become financially constrained. A few papers have started to look at some types of firm characteristics, and certainly Amir Tosh, our discussant, has a paper which says that those firms or those borrowers which are more bank dependent are more affected by credit supply shocks, which is certainly very intuitive. There's some work on the firm borrowing channel, which says that large firms, and in particular those firms which have multiple lending relationships, are able to insulate themselves from credit supply shocks simply by substituting away from the shock. That makes a lot of sense. Where are we going then? We're going to ask specifically how do banks implement a cutting lending? And there's really little to no evidence on the way that bank actually cuts borrowing when it faces a shock. So, in this paper, we're going to study the anatomy of a credit supply shock. We're going to be looking at lending to small borrowers specifically, and we're really going to be looking at emerging markets. And we're going to use micro-level data to trace the impact on bank lending at the borrower level. The framework we're thinking about is that if the bank faces a credit supply shock, there's basically going to be an increase in the shadow cost of lending, which means that the borrowing cost for borrowers should go up, and we're then going to explore the margins that the bank cuts. And we're going to look both at the intensive and the extensive margin. Specifically, do these margins vary by heterogeneity in borrower characteristics, collateral, or loan pricing? So we're actually going to have data on not just the borrower characteristics, but also the loan contract characteristics. And by doing this, I think this naturally just sheds light on whether borrowers can insulate themselves from such shocks and also financing constraints in general. So why has nobody really looked at this before? I think there's two main challenges to answering this question. First one is an empirical problem. You need an exogenous supply shock. Furthermore, this shock must have a meaningful impact on the bank's lending portfolio. Even if you need to have that, then you need to isolate the changes in credit supply from changes in credit demand to ensure you're really observing effects from a credit supply shock and not a credit demand shock. And if you solve the empirical problem, you're then really able to answer aggregate effects. To actually delve into the margins the bank cuts, you're then faced with a data problem. And in particular, you need micro-level data. You need to observe the loan contract, type, value of collateral, pricing, etc., that the firms actually have with the bank. So how do we get about this? The shock that we focus on is a shock within a multinational bank with small and medium-sized business lending to emerging market countries. And the bank basically is set up in the following way. There's a New York-based headquarters which allocates some approved lending to the local lending divisions. The local lending divisions then have total discretion over local lending. And this really is part of what the bank calls an embedded bank strategy. So the argument it makes for this strategy is that it wants to lend overseas, but it wants to compete with local lenders overseas, as well as offering the services and products that it can as a large bank. So what it does, it gives autonomy or discretion to local lending divisions to basically set up, make decisions how they want to, but also offer the product and services for a large bank. So it basically commits not to monitor the lending decisions of the local lending programs. These local lending programs then faced an anticipated uniform 20% cut in approved funds worldwide. So let me tell you a little about the shock. First of all, why did it happen? Well, the bank's argument for what happened, or the rationale, is that while they agreed not to monitor the lending decisions, they were slightly concerned that they didn't understand what was going on, so they decided to perform a stress test. It was that simple. And the stress test took the form of a 20% uniform cut. So, am I going to argue that this shock is random? Certainly not. It was a decision made within the bank. But because it's uniform across these same countries, I am going to argue that it's unrelated to country loan portfolio performance, and in particular, the individual credit demand in each of these countries. And I'll also show you some evidence on this as well. Furthermore, the shock may be non-binding. What does this mean? Well, the cut is in approved funds. And what happens is headquarters allocate, say, $100 million to Chile. The Chilean local lending division then has the autonomy to lend that $100 million however it wishes. The local lending program then faces a 20% cut, so that 100 million is reduced to 80 million. However, if the local lending division was only lending 72 million, say, of the original 100, that's non-binding. So we may not expect to see a full 20% cut when we actually observe what's going on. When did the shock happen? It was Q1 2004. And as I said before, we're really thinking about this in the framework of the shadow cost of lending increasing. And the rationale for this is that the local lending divisions have no alternative funds. So there's no retail deposits locally. The only funding they receive is from headquarters. What does the data look like then? It's a quarterly panel of loans made to small and medium-sized firms. We have the following borrower characteristics. So we have outstanding debt amount. And through a lot of our analysis, we're going to be looking at debt growth as our main variable of interest. So simply how that loan varies from quarter to quarter. We have a size classification, which is an internal size classification. These firms are generally quite small. I think the median firm has around about $5 million of assets. We have a risk rating, which is an internal classification again, 1 through to 5. And this is based on a combination of hard, soft information, interviews, annual reports, so on and so forth. And this really is where the local lending program has some discretion. So they can think about whether they want to use hard information, soft information, so on and so forth. We find that this rating runs from 1 to 5. We classify those borrowers with a rating above 1 as having high default risk, and approximately 8% of our borrowers have high default risk. So that's really how the bank looks at it as well. So the extreme 5 is in default, 2 through to 5 is various classifications of sort of being unhealthy. It's asset-backed lending, as I said. This is really important. This means that most of the loans, in fact about 83% of these loans, have some sort of collateral pledged to support them. And this collateral takes 2 forms. One form is non-specific collateral, and the second form is firm-specific collateral. And this is us basically classifying. And the argument for this is that non-specific collateral has some market value, which is independent of the firm value itself. So this is things like cash, real estate. On the other hand, firm-specific collateral has some market value, which is likely to be related to the firm value. So this is things like accounts receivable, firm machinery, inventory. So if we think about the perspective of the bank, what type of collateral would be most valuable, then perhaps it should be non-specific collateral. Collateral that has a market value independent of the firm value. We're also going to observe the pricing margin, and the pricing margin is basically going to come from 3 channels. There's going to be a cost of funds, a spread above the cost of funds, and then there's also going to be non-lending revenues. So I think this paper is quite unique in the sense that we observe non-lending revenues, and these are things like cross-sell income. So this is from cash management, FX, advisory, et cetera, et cetera. So these three channels constitute the whole pricing margin, and then we also observe the number of banking relationships. So this is, can the borrower actually go and access alternative sources of funds? So the sample itself, what we do is we examine firms 12 months prior to the shock, through to the shock, and then 6 months after the shock. We center, if you want the sample, on the shock, so time zero here is the shock. We start off with about 18 countries. That's basically the full lending program for the bank. Because of some data limitations, which are simply, we have to ensure we have data post-shock, and also we want data on collateral, we end up with 6 countries where we have full data. And our main tests are going to track borrowers from 12 months prior to the shock through to after the shock, and we're going to focus on those firms which stay with the bank, so don't exit the lending program. So we're going to look at the intensive margin. The countries we have are Chile, Czech Republic, India, Singapore, Slovakia, and Turkey. Okay, so let me tell you a bit more about the shock. Let me sort of try and persuade you the shock is actually worth examining and there's nothing else going on. So in this graph, I've basically plotted the natural logarithm of total debt outstanding. So this is across all borrowers that the bank lends to in this program. From 12 months prior to the shock through to the shock at time zero to 6 months after the shock. And we see that in the period prior to the shock, there's a small decrease in lending. In the period of the shock, there's a very large decrease. And afterwards, lending is somewhat flat. So we're not really seeing anything here which is suggesting that the bank was reacting to some sort of changes in credit demand in the markets. I'm then going to look at the dashed red line, which is the fraction of firms classified as having high default risk, and the dotted grey line, which is the fraction of firms which are actually in default, for which the bank is assigning losses. And the rationale for doing this is I want to ensure that the bank isn't responding to some deterioration in loan portfolio or some increase in losses. And if we look at the fraction of firms that are classified as high default or the fraction of firms in default in the period prior to the shock, we see there's really no change. It's not that the bank was facing high defaults in the period prior to the shock and then cut back lending. Let me give you a bit more evidence on this. So we look at one bank. We observe some shock. We're concerned that this shock may be, say, linked to credit demand and not just as a supply shock. Arguably, what we would like to do is we'd like to observe some second bank with exactly the same data and show that the second bank doesn't implement a reduction in lending. Of course, we're somewhat fortunate to have micro-level data on one bank, let alone 2 banks. So we don't have this. So what we do instead is we go to the Bank of International Settlements and take out lending into the countries we're observing from foreign banks. And then we observe this through our time period, and then we look at the growth in debt period by period for foreign lending into these countries, and compare that with debt growth for our own bank over the same time period. So what we see on the blue line is the BIS aggregate loans, and we're looking at debt growth. So we're seeing debt growth is around somewhere between 0 and 5% in the period prior to the shock. So lending from foreign banks into these countries is increasing prior to the shock. In the period of the shock, it's marginally positive. So other banks certainly aren't withdrawing their lending to these countries in the period of the shock. We then take debt growth for our bank lending, normalize this by subtracting back out the debt growth in the BIS loans, and we do see that there's a huge shock when we observe our bank lending compared to other bank lending. The conclusion here then is that it does appear to be a bank-specific shock which is unrelated to credit demand in these same economies. Why? Because other banks aren't also withdrawing lending. Okay, so let me show you what the data looks like a bit. So we have loan outstanding on average is about $500,000. Debt growth on average is around 0%. As I said, high default risk, those firms which are classified as, if you want, sort of being non-healthy, is around about 8%. Collateralization rate. I said earlier that about 83% of firms pledge collateral. What we do is we take the market value of collateral divide this through by the value of the loan, and this gives us collateralization rate, i.e. the percentage of the loan which is actually supported with collateral. And on average, this is 70.2%, a median of 100%. And this collateralization rate is split fairly equally between non-specific collateral and firm-specific collateral. Just to remind you, non-specific collateral is such as cash, real estate, which has a market value independent of the firm value. Total financing charge is about 14.5%. Around about 20% of this comes from cross-sell income. And finally, the number of banking relationships on average is about 5 or 6. So, unconditionally, what happens in the period of the shock? Of course, I'm going to build on from this and tell you unconditionally what happens and give you all sorts of controls, but unconditionally what happens? Let's just observe debt growth, which is the percentage change in debt at the borrower level, period by period, in the period before the shock, and after the shock. And the blue line plots this for all borrowers. So we see on average, there's a 5% reduction in debt in the period of the shock, unconditionally. Let me give you the first bit of evidence on breaking down what the cut or what the shock, the impact of the shock looks like across sort of heterogeneity in firms. So I look at, on the dashed red line, high default risk borrowers. So that 8% of borrowers which are classified as non-healthy. And we see the cut for these firms unconditionally is much, much larger. So already we have some evidence that the bank is cutting along the margin of risk. It's cutting those riskier borrowers much more so than the healthy borrowers. So, how am I going to formalize this and try and estimate it, conditioning on all sorts of stuff and controlling for everything I possibly can? So, we're going to estimate debt growth with borrower fixed effects. And in particular, we're going to track debt growth at the borrower level through time, include borrower fixed effects for the 1,528 borrowers. And the point here is that the benchmark for each borrower is the same borrower in non-shock periods. So that's if you want our best counterfactual. And our regression framework looks like this. So we have our left-hand side variable, our variable of interest is debt growth. We're going to estimate this on some firm fixed effect. A shock variable, which is going to be a dummy variable equal to 1 in the period of shock and 0 elsewhere. And then we're going to interact this shock variable with firm characteristics x. And this is really where we're going to pick up the heterogeneity and the effect of the shock. What sort of borrower characteristics are we going to look at? First of all, we're going to look at high default risk, firm size, number of lending relationships. Then we're going to look at collateral, and then we're going to look at pricing. We're going to start off by measuring the characteristics as a lagged variable, and then we're basically going to fix it by saying, let's measure it 12 months prior to the shock, so we're absolutely sure that the characteristics are totally independent to the shock itself. And throughout, we're going to include either country seasonal fixed effects or country industry time fixed effects. We would really like to include country industry time fixed effects everywhere. Why? Because this means that we're controlling or we're purging common effects within a country industry time. What type of effects do we mean? Well, things like credit demand. Credit demand is likely to be common within a country industry time. However, by including country industry time fixed effects, we can't estimate the shock itself. So we start off by estimating with country seasonal fixed effects. So let me show you the first set of results. In column 1, we're estimating debt growth just with the shock dummy. So we're going to ask, what is debt growth in the period of the shock compared to debt growth for the same firm in non-shock periods, controlling for some country time effects? And we see that the debt growth in the period of the shock is approximately minus 10%. So the shock on average impacts all firms, and they all receive like a 10% cut in lending. In column 2, the next thing we do is think about, let's build on that unconditional evidence I gave you graphically and split the sample by default risk. So we see the main effect on shock, and then we interact shock with high default risk, and we see those high default risk borrowers actually have negative debt growth in the period of shock, which is approximately twice as large. So they're almost twice as affected by the shock as other firms. In column 3, we've thrown the country industry time effects, where we're really throwing everything we possibly can to ensure that our results are robust. And we see that this effect on shock times high default risk, i.e. the riskier borrowers, still obtains. Then jump into column 5, what we're doing here is going to look at high default risk and also the number of alternate lenders the bank has. Now, the previous research on the firm borrowing channel suggests that if you have alternate lenders, you can easily substitute away from firms and take borrowing from elsewhere. It makes a lot of sense. So what we might expect to observe is that actually those firms which can go elsewhere when this bank actually has an increase in the shadow cost of lending would go elsewhere. So we might expect a negative coefficient here. In fact, we see a positive coefficient, which means that those borrowers which have alternate sources of funds get cut less. What does this suggest? It suggests that for this bank facing this bank-specific shock, they know they can't cut these borrowers. Because if they cut these borrowers basically can't be held up and they're going to go elsewhere. So that's how we're interpreting that result. We then look at collateral. So in column 1, I'm simply taking the total collateralization rate. The argument here is that if I'm a bank and a borrower pledges more collateral, then arguably that loan is somewhat safer. So maybe if I'm cutting along the margin of risk, I will cut those firms with more collateral less than those firms with less collateral. And we see precisely this. We see an aggregate shock effect of about minus 11% once again, and we see that the higher the collateralization rate, the less the effect of the shock. Importantly though, what collateral matters? So in columns 2, 3, and 4, we separate this, we decompose this collateral to non-specific collateral and specific collateral. And we see this collateralization rate effect purely comes through non-specific collateral. So it's not just the level of collateral that matters, but also the type of collateral. And the type of collateral that matters is this non-specific collateral, i.e. the collateral which has a market value independent of the firm value itself. This is precisely the type of collateral which is likely to be most valuable to you as a lender. Okay, I'm now going to show some evidence on the pricing margin. So I do exactly the same thing. We've got firm characteristics. I interact shock with some sort of level of high income, which is basically whether you're in the top quartile of income you pay to the bank within a country industry group. And I look at total financing charge, interest rate spread, and cross-sell income. The point to take away from this table is that if we look at shock times high income, we find nothing. So unlike collateral, it doesn't appear that the bank is actually cutting its lenders based on the income level they're providing to the bank. The bank is certainly cutting along the margin of risk, but it doesn't appear to be cutting along the margin of income. We find some small evidence when we actually further decompose a sample by high default risk and then high default risk, high income. But in the main, income doesn't seem to matter. So I've shown some evidence on the margins which the bank cuts, i.e. it cuts the riskier borrowers, it cuts the borrowers with the least valuable collateral. But of course, the framework we started with was the shadow cost of lending increases. And if that's true, we should observe that the borrowing cost for borrowers also increases. So now I'm going to test that. And I'm essentially going to ask, does the bank increase the cost of borrowing? I'm going to examine the cost of borrowing within firm and contrasting the period post-shock with the period pre-shock. Exactly the same sample, intensive firms again. And the borrowing costs I'm going to look at are collateralization rate and pricing. So let's look at collateralization rate once again. I'm going to first look at total collateralization rate, then decompose it to non-specific collateral, and then specific collateral. And what do we find? We find, first of all, in column 1, that post-shock, the bank is asking for more collateral. So the collateralization rate increases post-shock, consistent with the collateral cost of borrowing increasing. We then ask the question, where would we expect the collateral cost of borrowing to increase the most? Well, clearly where collateral is the most valuable. Where is collateral most valuable? Arguably where creditor rights are weakest. So we further decompose this effect to post-shock times creditor rights, and we find exactly this, that for those countries where creditor rights are strongest, the increase in the collateral cost of borrowing is lower. So what type of collateral matters? Non-specific or firm-specific. In columns 3 and 4, we show that this effect is much stronger for non-specific collateral, but for specific collateral, we find very little. So the firm is indeed increasing the collateral cost of borrowing, but entirely through the non-specific collateral channel. If we look at pricing, doing pretty much the same thing with pricing as I did with collateral, so I'm looking at pricing post-shock, comparing it to pre-shock within the same firm. Overall, we find some small effect. If we look at, if we look at interest rate spread, so this is basically the interest rate spread over and above the cost of funds, we find no effect. So where is this small effect coming from? It's coming entirely from cross-sell income. So what we're observing is that post-shock, within firm, cross-sell income is increasing. Now, why might this be? Well, if you put yourself in the shoes of a loan officer, where do you think you actually might be able to increase revenue the most? For increasing the interest rate spread, or increasing cross-sell revenue by actually offering more products? I think it's likely this last one. So that's what we're observing, that cross-sell income actually increases post-shock. So I've shown you some results on debt growth itself and the margins which are cut, the cost of borrowing. I'm now going to show that these results hold at the extensive margin. And I'm going to answer two questions at the extensive margin. First of all, if the bank-specific shock is impacting the firm's borrowing decision, are some firms forced to exit the borrowing program or lending program altogether? So I'm going to compare the entry and exit of borrowers in the period of the shock with other non-shock periods. Secondly, if the shock raises the shadow cost of lending, and therefore the cost of borrowing increases, do we observe that entrants post-shock have a higher cost of borrowing compared to entrants pre-shock? So what we're going to do is we're going to examine the loan contract for the 1,528 existing and 935 new borrowers. We're now not going to include firm fixed effects, but country industry time effects. Why? Because we want to compare borrowing costs for entry borrowers with existing borrowers, and perhaps more importantly, compare the borrowing costs for entry borrowers post-shock with entry borrowers pre-shock. So, to answer the first question, I'm just going to show you this graphically. If we look at the solid blue line, this is new entry firms, dashed red line is exit firms, and it's clear that in a period of shock, there are borrowers which just leave the lending program totally. If I now look at the extensive margin and new borrowers, I'm first of all going to be concerned that because I haven't got firm fixed effects, maybe new entrants just look different to the borrowers which the bank is already lending to. So in columns 1, 2, and 3, I'm going to test if new borrowers look different along the dimensions of firm size, loan size, and default risk by regressing these or estimating these on an entry dummy and entry post-shock. And I find that this is the case. So entry firms differ along the dimensions of these three firm characteristics, which means that when I look at the cost of borrowing, I'm going to have to include these as controls. So in column 4, I look at collateralization rate as my first cost of borrowing. I control for firm size, loan size, and default risk. And I show, first of all, in the top row that entry firms pledge more collateral than the existing set of firms. But more importantly, if I compare the entry firms post-shock with the entry firms pre-shock, which is the second row, then the collateralization rate is about 3.5% higher. So the collateral cost of borrowing increases even for new entrants post-shock. If I look at total financing charge, we find no evidence. So this is consistent with the earlier results, which said that the bank was really cutting its lending along the margin of risk rather than income, and specifically it was increasing the collateral cost of borrowing. So I think we're pretty much spot on. To conclude, we study a credit supply shock affecting a small and medium-sized firm lending division of a large multinational bank that operates in emerging economies. Why do we do this? Well, it allows us to trace the lending activity at the borrower level pre and post-shock. And it allows us then to shed light on what is borrowing constraints of small and medium-sized firms in emerging markets, and we find better rating, having more relationships, and what we think is very important, having not only more collateral, but better quality collateral. Further, the shock seems to affect the collateral cost of borrowing much more so than the pricing margin. And I think this is somewhat consistent with the bank being very concerned about moral hazard. The results also illustrate how firms can insulate themselves from lending channel effects through loan contracts. Thank you.